Bitcoin just smashed its all-time high, but what's next? Big money from corporations and ETFs is buying up BTC faster than it can be mined, and some top analysts are now calling for a $150,000 price target. Is this the start of the real bull run, or are you about to get left behind? The biggest moves might still be coming. In the latest video from Altcoin Daily, the hosts celebrate Bitcoin hitting a new all-time high and discuss the powerful forces driving this rally. The main point is a massive supply and demand imbalance. Corporate treasuries bought nearly 160,000 Bitcoin in Q2, and the new spot ETFs from firms like BlackRock and Fidelity have already scooped up 111,000 Bitcoin. In that same time frame, only about 41,000 new Bitcoin were mined. This supply shock is creating a situation where the price is coiled like a spring. An analyst on Fox Business is shown predicting a short-term price target of $140,000 to $170,000 for Bitcoin. The video does a great job of capturing the current excitement by focusing on a simple, powerful story: supply and demand. The numbers presented about the ETF inflows versus the newly mined Bitcoin are impossible to ignore and form the foundation of the market's current bullishness. It's a narrative that's easy to understand, even for those new to the space. The idea of an Ethereum rediscovery is also timely. This isn't just about political figures holding it, it's about real utility. With recent technical upgrades designed to lower transaction fees on its network, Ethereum is directly addressing its competition from chains like Solana. This makes the video's point about Wall Street's preference for Ethereum for tokenization even stronger. The entire market feels like it's shifting from a speculative phase to one driven by real-world integration and institutional capital, and this video really hammers that point home. In the latest video from the Crypto Rover channel, the host reveals he's currently sitting on $1 million profit from his recent Ethereum trade. He points out that Bitcoin is finally breaking above the key $110,000 resistance level, just as he predicted. He believes this is just the start of a much bigger rally. For a long time, Bitcoin was stuck in a consolidation phase, similar to what happened in October 2023, but it's now breaking out of a bull flag pattern. Based on this pattern and an inverse head and shoulders formation he's identified, he's setting his bull market top target for Bitcoin at $130,000 to $140,000. It's hard to argue with the excitement in the market right now. The breakout above previous resistance levels for Bitcoin is a genuinely positive sign that has traders feeling confident. The point about the BlackRock Ethereum ETF inflows is particularly interesting. That wasn't just a small purchase, it was a significant institutional buy that shows real conviction following the SEC's recent approval of spot Ether ETFs. This institutional adoption is the big story of this cycle. While technical patterns like the inverse head and shoulders are useful for framing the market, the real fuel seems to be coming from these massive ETF flows. The market is clearly reacting more to capital inflows than to anything else at the moment, which supports the idea that this upward trend could have some serious legs. In the latest video from Lark Davis, he's celebrating Bitcoin's new all-time high, even though it was only by a few dollars. He points to an econometrics model that puts Bitcoin's expected price at $119,000, while his own prediction for the next local top is around $150,000. The buying pressure continues, with a new company called K-Wave Media securing $1 billion to add Bitcoin to its balance sheet. He also brings up the circulating rumors that Fed Chair Jerome Powell might resign. It's hard not to get caught up in the excitement Lark presents here. The sentiment in his video mirrors the general feeling in the market right now, a mix of relief and renewed optimism. Bitcoin just nudged past its old peak, and that's a powerful psychological signal for traders. While his $150,000 target sounds high, it's not totally out there given the constant news of more institutional and corporate buying. The talk about Jerome Powell is mostly noise for now, but if it ever happens, expect some serious market fireworks. His analysis of the altcoins is pretty solid. Solana's momentum is tied to real developments like its potential ETF, while XRP's move seems more technical and might need more of a story to sustain a run to $4. The focus on Pangu and Bonk really shows how fast the meme coin space moves. A month ago, different coins were in the spotlight. It's a reminder that while the big players like Bitcoin set the tone, the real wild action is often happening further down the charts. In the latest video from Ben Cowan, he introduces a new metric analyzer tool he's added to his Into the Cryptoverse website. This tool is designed to show what has historically happened to the price of an asset, like Bitcoin, after a specific technical event. For example, he shows that after Bitcoin gets its first weekly close below the 50-week simple moving average (SMA), the price, on average, is only up about 3 to 4% 3 months later. On the flip side, when Bitcoin gets a weekly close above the 20-week SMA, the average return a month later is 3%, but it jumps to 40% after 3 months and a huge 376% a year later. He does mention that very old data, like a 2,300% gain from 2012, can skew these averages, and he's thinking about ways to make the data more relevant to today's market. The tool isn't just for Bitcoin. You can check what happened to Ethereum or Solana under similar conditions. Ben is looking to expand its capabilities and is asking his audience for ideas on other metrics to add. It's my view that this kind of tool is becoming increasingly popular because it democratizes a form of quantitative analysis that used to be quite difficult for the average person. While professional platforms offer complex scripting languages for backtesting, Ben's tool presents a straightforward question-and-answer format. It directly addresses common what-if scenarios that many crypto followers think about, like what usually happens after we cross the 50-week moving average. By packaging this data in an easy-to-digest way, it lowers the barrier to entry for data-driven decision-making. The real strength here isn't just the tool itself, but the context Ben provides, like acknowledging that historical averages can be misleading without proper context. This approach bridges the gap between simple charting and heavy-duty data science. In the latest video from Coin Bureau channel, Nick explains how the line between traditional stocks and crypto is blurring. We're moving into a world where you can trade tokenized shares of companies like Tesla or Nvidia directly on a blockchain 24/7 without a traditional broker. The old system of stock trading can take days to settle, but putting shares on a blockchain like Solana cuts that down to mere seconds. This opens up markets to anyone, anywhere, and allows for fractional ownership so you can buy just a small piece of an expensive stock. My take is that the video does a great job of capturing the excitement around tokenized stocks, but the real story is the slow, cautious dance with regulators. The technology itself is impressive. Being able to trade a fraction of a share on a DEX at 2 a.m. is a genuine innovation. However, the projections of a multi-trillion-dollar market by 2030 feel incredibly optimistic when you look at the current regulatory environment, especially in the US. While Europe seems more open, as seen with Robinhood's launch, the US Securities and Exchange Commission is moving at a snail's pace. The success of this whole sector doesn't just depend on tech like Solana or oracles like Chainlink. It completely depends on getting clear legal frameworks. Without them, this will remain a niche market for crypto enthusiasts rather than the future of finance for everyone. In the latest video from the Cryptos Rush channel, the host talks about a very exciting day for crypto, with Bitcoin pushing into all-time high territory. He notes that Bitcoin hit a new peak of $112,164 before settling around $111,000, partly because of a short squeeze that liquidated bearish positions. While the stock market was mixed, Nvidia led a tech rally by becoming the first company to reach a $4 trillion market cap, which added to the positive feeling. The host explains that recent Fed minutes confirmed there won't be a rate cut this month, and political pressure from figures like Trump isn't the main driver. Instead, the price surge is due to a mix of many factors coming together. There's massive, ongoing buying from institutions, with corporate treasuries purchasing 159,000 Bitcoin in Q2 alone, not even counting the ETFs. He points to the success of companies like Japan's Metaplanet and El Salvador's president, who is now up 137% on his country's Bitcoin purchases. Technical charts also look very positive, with some analysts projecting the next stop for Bitcoin could be anywhere from $130,000 to $150,000. The long-term view presented is that Bitcoin is on a journey toward $1 million and beyond. The video paints a very bullish and forward-looking picture of the market. It's interesting how it blends current events with future price projections, like Bitcoin at $111,000 and Nvidia hitting a $4 trillion market cap. While these specific numbers are speculative for now, the underlying reasons given are very much in line with today's market. For instance, Nvidia did recently cross the $3 trillion mark, becoming one of the world's most valuable companies, and the debate around Fed rate cuts is a constant topic. The idea that a combination of institutional adoption, retail interest, and macroeconomic hedging is pushing crypto forward is a common belief. The price targets for altcoins, especially XRP at $240, are extremely optimistic and represent a major market shift, but it effectively captures the high hopes sentiment that many long-term investors have. In the latest video from the Crypto Banner channel, David from David Tech tells a story about how seeing a community member hit #1 on a copy trading leaderboard sent him on a mission. He quickly realized that most top traders were just one-shot wonders with super risky strategies. This led him to build a tool to analyze data from over 10,413 traders, and the results weren't pretty. He found that on average, 9 out of 10 copy traders blow up their accounts within 3 months, and their followers typically lose around 23% of their money. The few consistently profitable traders had a max drawdown of less than 25% and kept over 55% of their followers in the green. To fix this, David is launching his own AI-powered trading bots on copy trading platforms like Blowfin and Bybit. He's making the whole process transparent by starting 2 public accounts, Lambo Guy and Mr. Chadow, each funded with $10,000. He shows one account's equity curve, which grew to $16,347 over 180 days, while also being open about the fact that the accounts are currently in a drawdown, which he explains is a normal part of the process. It's interesting to see someone directly tackle the incentive problem in copy trading. The platforms often push traders with explosive, short-term gains because it looks good on a leaderboard, but this usually comes from extreme risk that eventually wipes out followers. David's approach of using a diversified army of bots is a logical countermeasure. Instead of betting on one person's hot streak, it diversifies across multiple strategies, timeframes, and coins, aiming for steady growth over time. The real test, of course, will be performance. Promising to be transparent and even show the drawdowns live is a bold move. It shifts the focus from chasing lottery ticket wins to building a sustainable, long-term system, which is a much-needed change in that part of the crypto space.